show. Thanks for joining us today. And we're going to go and look today not at the Halloween budget per se, and not at some of the wider implications of the changes that are going on in there. But what we're looking at today is some of the strategies and approaches that can be used for inheritance tax planning post the Halloween budget. Let me redress what's happened over the last year or so. The legislation was actually introduced in April last year by the last government, and the Labour government confirmed that the non-dom status is to be revised radically from April 25. So it started in the April 24 budget, confirmed in the October 24 budget that the non-dom status is not being abolished in the UK, but it's been radically changed. Let's have a look at some of the history there. Actually, inheritance tax has started in 1694, so just bear that in mind. It's not something that's new. So probate duties, stamp duties were introduced in 1694 in the UK, but in 1779, when income tax was introduced, it also established quite clearly the definition of a non-dom status. So when income tax was introduced in 1779, any income or capital arising from around the world was not taxed in the UK. And that's the basis of the non-dom status that we have today. But essentially, it was mainly income taxes were taxed. Capital gains tax, as we know it today, was only introduced in 1964. And inheritance tax, as a specific type of capital gains tax, was then not introduced for another 20 years in 1986. Before 60 years later, in 2024, capital gains tax rates have been increased by 80% for investors in the UK and business holders. So there's some radical changes that have come about. For years now, over the last 20 years, tactics like freezing allowances and cutting allowances have been applied by successive governments. Property has been split out from other investments to have a separate category of capital gains from investments from inheritance tax. And to be fair, that's now all coming together in one measure of inheritance tax. So capital gains tax has increased by 80% for investors, from 10% to 18%, and for high rate taxpayers from 20 to 24. So it's now the same tax rate as you'll get if you are a retail property investor. So any capital gains in the UK now is 18 or 24%, unless you die, in which case inheritance tax applies instead of capital gains tax at 40%. And you know, the inheritance tax in the UK it is in the top 5 highest rates in the world. So UK is now a high rate inheritance tax payer, and it applies to non-doms more quickly. But it's worse than that, even for UK taxpayers, because pension funds have been added into the calculation of inheritance tax. In the UK population got used to seeing frozen rates, but over the last 2 or 3 years, capital gains tax personal allowances have been reduced from over 12,000 down to 3,000, and if it's in a family trust, down to 1.5. So you've got £1,500 of capital gains tax a year allowance before you start paying 18 or 24% tax, unless you die when you pay 40%. So I've got 18, 24, 40% tax on all your business, property, investment assets when you die worldwide. There are allowances, but they've effectively been frozen both for income and for capital for many years. But even so, if you are a sort of a family and you're married, then a couple can have for their residential property 175,000 to add on to 325,000, so you've got 500,000 each. So potentially a married couple can hand over £1 million free of inheritance tax to their children, which is about half the price of an elite residential property in North London, for example. So it is a substantial amount of relief if you own a small terraced house in a market town in the UK. But if you part of the metropolitan elite, then you need that £1 million just on your residential property alone. So this is the backdrop that we've got now, and then the non-dom status has been changed from the complication. Now, with taxpayers, there's under the current law, there's two sets of rules. Your domicile, your tax domicile, and your tax residence. Tax domicile is where you're born, where you're from, what your origin is, and to change your tax domicile is very, very difficult. And in essence, your tax domicile is your default tax residence, unless you're a tax resident in another country in which has a double taxation treaty with your home country. That's now all being scrapped, and it's being moved over to and merged in with the tax residence basis. So it'll be some sort of simplification. So if you're tax resident for the year, you're also tax domicile for the year, and that'll be the basis of calculating whether you're domicile or non-domicile. Under the current rules, the domicile, an expat is domiciled in the UK after being in the UK for 15 tax years or more. So an expat can go to the UK, start a business, start a family, invest in the property, take a long-term contract, make some money, and leave without ever being domiciled in the UK. And for 15 tax years, their worldwide income and capital gains is not taxed in the UK in the same way as it would be if they're a British national. If you're British domicile, if you come from Britain or you've been in Britain a long time, your worldwide assets are subject to inheritance tax. That's 40% on everything you own, business, property, investments all around the world. So that can make a radical difference. If you own overseas property in Cyprus or Spain or Portugal, or you've got investments, offshore investments, then if you're domiciled in the UK, they're included in the 40% tax grab from the change to the non-domicile rules. Conversely, for the non-doms, it's the same. So that for 15 years, those external assets don't count. But once they become domiciled or deemed a domicile, then they become taxable in that year. So the residence-based system is very much exactly the same basis as we've got now for a tax residence. So to be non-resident, you need to meet the statutory residence test rules, and that's how domicile will be determined. And there's some good news and some bad news on how that will change. So let's just clarify now what exactly the new non-dom rules mean for expats going to the UK as well as expats leaving the UK, because there's some good news there and some potential clarity and future for long-term UK expats living and working abroad. So if you come to the UK now, and this applies from April 25, so this applies to UK expats already in the UK. So after April 25, they will be deemed domicile in the UK if they've been a tax resident for 4 years. It doesn't need to be 4 consecutive years. It could be 4 in the last 7, for example. But once you've been tax resident in the UK for 4 years, you're deemed domicile, and therefore you've got a worldwide liability to income, capital, dividends, interest, and inheritance tax globally. And that's including expats already in the UK now, there for 4 years. If you're a UK expat that leaves the UK, the same doesn't quite apply, because once you're deemed domicile in the UK, or you have a domicile of origin, you have to be outside the UK for 10 years before you lose that tie. And I just realised I messed this up, so sorry about that, people. Please forgive me. Um, the the so if you're an expat leaving the UK, then you deem domicile anyway in when you leave the UK for different reasons. So uh, once you leave the UK, if you're UK domicile of origin or already deemed domicile because you've been in the UK for more than 4 years under the new rules, then when you go to your new location, you're still going to be deemed domicile in the UK for at least 10 years. And to get that 10-year, um, uh, uh, to get a full scope of that, you possibly need to be out of the UK for as much as 20 years. So a non-dom coming to the UK is in the UK for 4 years, is then deemed domicile. It takes them at least 10 years to lose that tag once they leave the UK. And for UK expats, again, there's this clear path now where we'll have a measurable path where you can say between 10 and 20 years you've been outside and you're no longer domiciled in the UK. Because at the moment, the only way you can prove that is if you've got written evidence, notarized evidence to support your claim to be have a domicile of choice outside the UK, and then it's still subject to HMRC assessment, so it makes it quite difficult for that. So the non-doms now, any, let's just summarise the non-dom position. If you're an expat in the UK, after 4 years in the UK, you're deemed domicile. That's a cut of 11 years of the current system. That will, if you're UK expat that's going abroad, you're going to be deemed domicile for at least 10 years. If you're deemed domicile expat in the UK and you go abroad, you return to your home country, the UK is still going to tab you for inheritance tax for up to 10 years before you can start shaking that tax tie down. So the creep has gone quite a long way into the future, not just for UK expats, but also for UK uh, uh, expats in the UK who are going abroad. That tie is going to stay with them now for potentially 20 years. And with exchange of information and improvements on verification of uh, uh, beneficial owners of businesses and assets and property and trusts, then it would be easier for the tax office to assess that. So it's important to get your planning right and look forward to what could be the future. So uh, that's what we need to look forward to. So how can we do that? How can we plan ahead in an effective way? Um, well, there's two ways. One is a short-term view, is that the UK could change radically, and you could say, well, if I'm an expat coming to the UK, I'm not going to be tax resident for more than 4 years. I'm going to limit my time. Now that does two things. A, uh, under UK residency rules, you need to be a citizen for more than 5 years to become a permanent resident or indefinite leave to remain, as they call it, and to then get citizenship in the UK. That could be an attractive thing if you want the freedom of the passport, the status of the UK. But it's not an absolute thing. But now, the idea of staying in the UK for 10 years to get citizenship and dual citizenship and then living and working abroad elsewhere, going home, you're going to be carrying this inheritance tax time with you. So shorter term residency periods is a possible, or potentially, mixing your time between the two locations, and the statutory residence test during that time will then determine whether you're tax resident in that year or not. So then you're looking at your business ties, your family ties, your days in the country. So generally, if you're less than 90 days in the UK as a tax year, you've got a chance of being non-dom. But over a 3-year period, that's quite heavily monitored, and the amount of business, work, family ties that you have in the UK, and your habits as well. The habits and patterns that you and the intentions that you have can demonstrate that you're tied to the UK therefore tax resident in the UK. And if that is the assessment, you're now also domiciled to the UK for that tax year as well. And these will add up over the years, but over a short period of time to deem you domicile and therefore liable to capital gains uh, on your worldwide assets, income tax on your worldwide assets, remitted or not remitted, as well as inheritance tax in the event of death. What's the second strategy that you can adopt? Um, you can give the money away. You can give it away to a charity or give it away to a family trust. A charity is a form of trust. Um, sorry, but let me rewind. Another key thing for the inheritance tax is that pensions are now added into the calculation. Up until now, any pension fund was not part of the inheritance tax calculation. If you want a £20,000 pension, then generally in today's market, you're looking at something like a £100,000 fund to create a 5,000 a year pension. So if you've got a 20,000 pension, you've got a £400,000 pension fund. Um, and that is above that takes a person directly into inheritance tax liability. Those pension funds are now automatically added into inheritance tax, which will dramatically increase the number of people that become liable to inheritance tax on death. The first death uh, uh, deferral is still applied. The £1 million allowance for a couple is still applied, but 400,000 for a 20,000 pension, that's £1 million for a 50,000 pension. That potentially is going to boost your inheritance tax liability at some point to your family. So it's something to bear in mind. There's a 40% liability on your worldwide assets, property, business, investments, and pensions when you die because you deem domicile in the UK. And that is now, for an expat going to the UK, ridiculous 4 years. Let's have a look at another strategy. Another strategy to avoid is to gift it away. Pensions are held in trust. Um, Charities are forms of trust. Investment funds are often investment trusts. There's no reason why you can't set up your own family trust. And this is where Proact could help and support you in your approach. Um, we've got a Cyprus office base where a family trust for an international expat. You don't need to be resident in Cyprus. You don't need to leave your home country, but you can gift into that trust, and that there's no further taxes on that trust that is held there. Now, if you're putting in investments or business or property or other assets in there, there is potentially still some local taxes. So if you've got a property in the UK that's in a Cyprus family trust with property rental income, the property rental income is fixed, accessible in the UK, but the asset is held by the trust. So there's no additional assets in the trust. So the owner of the asset is the trust, and therefore you're potentially mitigating from inheritance tax. And this is the key. So um, a family trust can protect you against certain taxes around the world. It gives you a non-remittance basis of taxation, but there's no inheritance tax and no capital gains tax. So as long as the right asset's held in the right way within the trust, then you've got the whole gamut where you can have a family controlled fund that passes down the generation, but also protects you across the border um, to fund your lifestyle. You don't need to own the property to live in it. You can rent a property. You can rent it off your family trust just as well as you can rent it off a third party. You can make your investments and accrue the capital gains in a tax-free environment rather than putting it into holding it yourself. Trust in the UK taxed up to 45%. Your pension on death is taxed up to 40%. on inheritance tax. A trust is taxed up to 45% on income tax. So a Cyprus family trust can make a big difference. I'm not saying that the tax authorities won't change the rules and try and introduce the taxes and increase them in the future. They've done that since 1694 with death duties and 1779 with income taxes. So the world will change. But a family trust avoids the cost of probate, avoids the delay of probate, where it can take a year or two to settle an estate, but it avoids the inheritance tax assessment. If you avoid that inheritance tax assessment on the assets held in the trust, you save yourself 40% tax in the UK. And the important thing about a Cyprus family trust is that you don't need to be Cyprus tax resident. So people can do this from the UK. We can do that from any jurisdiction around the world. Now, there's different tax rules that apply depending on where you're tax resident and where the assets are held. But as far as family trust is concerned, you're not adding any additional tax liability in there. So, in summary, strategy for avoiding inheritance tax could involve lifestyle, where you limit the time that you spend in the UK and you're just on a short-term residency permit up to 4 years as a tax resident. But what is changing is that tax residence now defines that you're domiciled in that year, and as 4 more years gives you liability to worldwide dividend, interest, capital taxes on all your worldwide income and capital gains, as well as inheritance tax on death. The good news is that UK expats relocating overseas between 10 and 20 years, depending on their circumstance, can be free of the yoke formally of UK inheritance tax, and you can argue that case if you die after the 5th of April 25. If you die before that, the old rules apply. So you can potentially avoid inheritance tax as well, whether you're a UK citizen or if you're an expat leaving the UK. Bearing in mind that once you're deemed domicile in the UK, it's at least 10 years outside the UK. So whether you're deemed domicile by residency or deemed domicile by origin as a tax resident of the UK, the inheritance tax yoke is going to be with you for at least 10 years once you leave the UK. So for strategies and tactics personal to you, we offer a free review and guidance. You can book that at productpartnership.com on our contact us page, where you can send us a written inquiry from there as well. And we can help you and guide you every step of the way. If you've got an existing trust that's being taxed in the UK or another country, you could consider how we could help absorb that into a tax-free Cyprus family trust. But all the time, if we can gift, we can potentially use the allowances now, the potential exemptions going forward, the £1 million allowance, although it's been fixed till 2030, you can still use that to protect your family, property, business, pensions and investments across border and down your generations. Thanks a lot for listening, and we'll see you next time.